Welcome to the Dividend Talk podcast, episode 104, quarter two 2022 portfolio review. Hey guys, welcome back to another episode of Dividend Talk. Today, me and European DJ are going to discuss our portfolios and how they performed over the second quarter. All that and more. See you on the inside. European DJ, 2-year anniversary. What's up?
Hey, yeah, this is awesome, right? We're just talking about before the podcast that this is the last episode of season 2, and we will start season 3 next week with episode 105. I mean, it stays amazing, right? I know we just had the celebration of the number 100, right? But yeah, it stays amazing, and I like celebrating these milestones. So cheers on you.
Yeah, they're important to celebrate. I mean, 2 years is quite a feat. Particularly something I think we've only missed one weekend out of
Yeah.
all this time, which is quite astonishing given our our busy schedules. But it's here's to another couple of years of this anyway.
Yeah, and what I like as well, right? Our listener base that we see in the statistics is like it's like dividend growth. Yeah, you start low and it keeps on compounding, which is really, really nice to see, right? That it follows quite a similar pattern. So
Yeah, and look, I don't follow the numbers too closely because it's more about the community, and
exactly.
we've had a really strong community since day one, and it seems to be growing and growing. I get tons of emails. I try right back as quickly as I can, but I'm starting to get so many of them now that it's getting harder. I might need to hire an assistant, but it's I mean it's incredible. It's incredible. But hey, let's look at some. Actually, before we get to the news of the week, okay, I have a question. I have a question for you. Something that's really bothering me. Are the airports as fucked up in mainland Europe as they are in Ireland and England at the moment?
So from what I've been reading in the news, for instance, in the Netherlands, yes, it's exactly the same. They are canceling some flights. Effectively, from what I understood, and I'm not paying too much attention to this, so I might be wrong. But from what I understood, is like in the pandemic, there were not so many flights going on. People were being let go, and now
Yeah.
suddenly everyone wants to go on vacation again, and there's not enough personnel on the on the airports to do the, for instance, the shipping of the suitcases and everything.
Yeah.
So that's my understanding, and that's why they can't commit to all the airplanes coming in and going out and all the holidays. So
Yeah, I mean it's crazy. I know people who have flights have been cancelled, they've been stranded, luggage missing. I myself, I drove up to collect my sister-in-law from the airport on Thursday, and it was just chaos. Even getting into the airport. I mean,
yeah,
getting in is usually quite smooth. It'll
yeah.
take it 2 minutes. It took me 20 minutes from from the start just to get to the end, and then their flight was delayed, so I couldn't stay. So I had to keep doing a loop until they came back in. It
Yeah.
was it's
Well, for me, this is finally a side of capitalism that we are seeing that is more on the employee side. I mean, if you've been ditched during the pandemic, like a number, then I can imagine that you find another job where they treat you better and that you don't come back. And now the airports need to figure it out themselves with the airlines, and maybe they need to start paying better. And I know we will feel that in the wallet when we go on vacation. But hey, that's how it is, right? I think if you treat them like second-class citizens sometimes, then that's what you get in return.
yeah, but I mean it's easy for you guys. Yeah, you're locked by land. You're not locked by water, so you can drive to wherever you want. Us over here in little old Ireland, we need these airplanes up in the sky, which is quite frustrating because to get to anywhere, we either need planes or boats.
Yeah.
And it's
So give those people on the airport more job security and
I
better
agree.
wages.
Yeah,
Yeah.
and better hours working too.
Yeah. Yeah. So no holiday for you then?
No, no, and I know we were all meant to meet up in August, but it's just too crazy, too unpredictable. I can't afford to be stranded in Europe with work and stuff. So I'm not flying until it settles down. It's um it's too risky.
Nice, nice, nice. So tell me then, what's really in the news for this week for you?
So I haven't really kept track with the news, but one thing that always reminds me that earnings season is coming up is Walgreens. I think they're always one of the first companies to deliver their quarterly earnings, which they did. I've only briefly went through the headlines. I haven't got into the meat and bones, and it's pretty much as expected. I've spoke a lot about Walgreens. We know they relied a lot on COVID and vaccines, which you still have to a certain extent. Yeah, but we're starting to see now a decrease in revenue. They also had some litigation that they had to pay out, which impacted their operational income. And I was surprised to see that they have another business unit. So they are developing Walgreens Health, which is look, it's interesting to see what they do with that. But all in all, from the headlines, it's as expected. I don't know why the share price tanked straight afterwards. I don't know what people are expecting. I think they just want happy news all the time, but it's 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 okay. There was some encouraging signs. Boots in the UK are doing quite well. Online sales is growing as well. So it's pretty much a damn squid in my opinion. Just I think their forecast was low digit growth. I don't see that changing. If anything, it would be
Yeah.
probably 1%, maybe 2% max.
So are you buying more?
No, I'm not buying more. I think I've said that before. I have enough shares. I am selling covered calls on them, but at higher price. But I'm not buying more.
Mhm. Okay, cool. So, and what are your thoughts then about Bitcoin, and not so much about Bitcoin or maybe like cryptocurrency, but more about those cryptocurrency, what is it, trading platforms like how it's called Celsius, Coinbase, that have locked their accounts that you can't withdraw money anymore.
Yeah,
What do you think about that?
I mean, the whole point of crypto wasn't it that it was an ecosystem where you did not need regulations. You didn't have banks that could do this. That your money was free. You could move it around. And it's just turning out not to be the case. Like everything that was sold fundamentally about cryptocurrency seems to be flawed and incorrect. I mean, it was a hedge against inflation. No, it's not. Do you know what I mean? It's digital gold.
Store value, yeah.
No, it's not. Your money is safe. No, it's not. I mean, if anything, it's probably less safe because you have no access, no control over it. There's no
It
regulations.
depends, right?
Mm.
If you own the Bitcoin yourself, it's different than when you have it in a wallet with such one,
Yeah, but
right?
but having it in a wallet is no difference to me having money in a bank or an investment broker.
Exactly.
You know,
Exactly. Exactly. And then you need regulation.
yes, exactly, because these guys can pretty much do what they want, and they can close down, and there's no regulations here. So look, it it to me it feels like 2017 again. We I was on that hype train. I got off it. I did have some regrets. I was talking to you maybe last year when we start to see it going up again, but it just seems like it's the same boom bust, boom bust. It's a risky sector. There's money to be made, but there's also a lot of money to be lost.
Yeah, and I think what we are seeing now also with Celsius, right? Because I often got the question like, why are you not using the passive income from there? They were giving you more than 10%, right? And for me, if you're in such an industry, then more than 10%, I just don't trust it. And people can tell me whatever they want. I just don't like they're cutting out the banks, and it's direct between you and the one who wants to borrow money. um, Still it's all too good to be true, because who wants to pay 15 or 20% interest rate on something, right?
Yeah.
Because that's what we're talking about here. And now they have seemingly some liquidity issues. So I don't know really what's the truth, but for me these all feel like Ponzi schemes in the end. So I'm staying away for this, specifically if there's no regulation. Then I can't trust at all this money that you're receiving as passive income, because I'm more interested in protecting my principal in the end.
I, I mean, passive income became such a buzzword, and I'm guilty of that as well, passing off passive income and talking about
Mhm.
it and so on. But it became such a buzzword that people were throwing themselves into lots of different risky areas. Person to person loans is another one. And people get sucked in when it goes good. It seems like it can last forever, but there's always risk. Like there's nothing truly passive, I don't think.
Yeah.
There's always some bit of work. I mean, dividend investing is probably close, but I mean, look at the work we put in. Index investing, you might say is passive, but again, you have to still put work in. Do you change
Yeah.
funds? And there's always some bit of work. So putting your money into these sites and just expecting it to sit there and continually generate money is
Yeah.
probably unrealistic. And it's going to be a hard lesson for people. I know a lot of people lost a lot of money, just like
Yes.
2017, which I feel sorry for. But it's I think that's why you stick to the tried and tested, good old,
Yeah.
good
Yeah.
old.
And I don't trust regulators fully either, right? I
No,
also think it's an old boys network, but at least they need the companies will need to report like the 10K, all these kinds of things, right? So it gives you more information than almost being fully not regulated. And the Security Exchange, what is it? Commission has
yeah,
been also sending warnings, as an example, to those companies like, hey, we are lacking transparency. And I pay attention to that. And the same is like the Hero. The Hero also got again a 2 million fine for something earlier this year. And that went to Flatex, right, in the end.
yeah,
And it also gives some signs that in the Hero, they need to also do a better administration. But I think that was also one of the reasons why they went to Flatex.
yeah,
Yeah, and usually it comes with a cost as well. Yeah, because if something is totally for free, you need to really ask yourself, okay, so how are they earning money on this? Am I then really owning my shares, as an example? Are they really locked up for me, and am I protected when the company goes bust? Um, so I love those new business models, but you always need to check like who's really the winner here in the system.
yeah, yeah. Look, there's always a risk, and let's be honest, your money is not 100% safe unless you have it sitting in a safe, locked under your
Exactly.
bed or something. So there's always
Yeah.
always risks. Hey, but enough doom and gloom. Let's talk about your portfolio in this
Oh,
quarter.
I mean, we talk a lot about porn chart, right? When we see those dividend growth histories from some really iconic companies, but man, I was so positively surprised with my dividend income. Do you know that just in the quarter 2 of this year compared to last year, my dividend income grew 82%?
And
82%, right? I'm thinking here about 10
it's,
or 15% in
it's
general at this
huge.
stage of the journey.
Yeah, it's a huge number considering where you're at. It's a huge number.
Yeah. And so in April it was 46% up. In May, more than 100% up. And in June, 73% up. And May is my most is my top notch month in the year because of the European stocks.
Yeah,
And of course, I bought some European stocks also last year. Also, we have, of course, a stronger dollar, like 10%, 15% different compared to last year. But even then, my average would have been up like probably more than 50, 60% for this quarter. So I'm blown away by this. And I've been sticking to my plan. So I didn't, how you said, I didn't necessarily spend more than usual. It was in my plan to spend a little bit more than usual, but the stock market just came down, so I've been able to buy companies with 4% yield, 5% yield, 6% yield that were last year trading at maybe 3% yield or something like that.
mm,
So take a T Rowe Price Group that I started a position in. Think about Castellum, which is now trading about 5%. Yeah, Viatris. So these are just good yielding companies. And some of these are like top notch. Texas Instruments now above 3% as
mm,
well. So my portfolio yield went up from 3.18% to 3.65% just in the last 3 months. Yeah, and that's a lot because my total portfolio value actually grew by 1.3%.
wow.
I stashed, of course, money in the stock market, but what you could say is like I lost a quarter a single quarter of investments. Yeah, you could say like that if my portfolio was flat. So my investments and my dividend income that has been reinvested made sure that I'm still like overall on my portfolio for this year, I'm like up 6-7%. And this is for me really the power of disciplined dollar cost averaging. And if there's no better time to ever experience the power of it, it's today when the stock market is down more than 20%. Some stock portfolios, because of the composition, even more than 30%.
Yeah.
I'm up over this year, and it's really, really. These are the years I think where you will see in the long term the difference between performance, like what actually Warren Buffett is doing. He's not outperforming the market 2 years ago. He is outperforming the market now, and the outperformance now is much more powerful than 2 years ago in the boom and bust that we have seen with growth stocks.
Yeah.
I'm experiencing that now, and it's really making me. It's almost a humbling experience from that point of view.
Yeah. And what I've noticed is your portfolio goal is inching towards 50%.
Yes, yes, exactly, exactly. I'm going there. It's now 44%, let's say. If I would reach 50% by the end of the year, that would be beyond my expectation. But honestly, I think it's possible still with the dividends that are coming in. I think that by the end of July, mid-August, I might have earned already the same amount of dividend income as the whole of last year. And again, I was expecting this to go slower at the moment because of I'm now in the 7th or 8th year of my journey. But it has been just a fortune of the last 6 months to invest because the stock market is down, lots of opportunities. So I invested positions in T Rowe Price Group. I bought a share in ASML, HPQ. I went big in Castellum over the last 4 or 5 months, let's say. I initiated a position in Starbucks when it was trading $69. I bought some Allianz, which is also trading more than 5%. I initiated a position ASR, a small one, yeah, also 5 or 6%. So the insurance companies are really yielding nicely now,
Mm.
and some of them have really safe dividends. Yeah, and Texas Instruments is probably the one that I'm most proudest on. But I also bought Ambra, and that's the first position in a Polish stock. They sell cider, this kind of drinks here. It's growing nicely, and it's I think the only pure dividend payer, growth payer in Poland that I've observed so far, also yielding around 5%. Yeah, and then what I sold this quarter was Philips because I'm done with it, Fresenius and Novartis, and I wrote about that in my spring cleanup portfolio.
Yeah.
Why? And also that cash gave me better yield in return in safer dividends. So all in all, yeah, it's been awesome just this quarter.
Yeah, it looks quite good for you actually, and it's it's incredible to see that increase. An 82% increase is incredible considering how far in the journey. You expect to see that maybe year one, year two, and slow down to maybe 15-20%. So it really shows your discipline if you stick at it, and I think it's an inspiration for me and for those listening as well, how you make a plan and stick to it. Well done.
Yeah, but it's difficult, right? Because I can't even explain you how often I felt the idiot in the room. Yeah, when you hear all the other numbers and such, and also investing right now. For instance, I started Castellum at 200 Swedish crowns. It's now, what is it? I have not checked, but maybe 135. So I mean, if people have been investing with me, they might feel like, oh, this EDGI, he's 35% down. Yeah, damn, we lost a lot of money. And I feel like, damn, I got only better opportunities to buy this stock because I look at it from a dividend income point of view. It's on the shelf for the next 10 years. So why worry about the share price?
Yeah, yeah, true.
It's the mindset, right? So if people are thinking like, this idiot, he lost 35%. I don't trust what he says. Well, first of all, always do your own homework, of course. But for me, I just feel like I'm buying a company for 70 cents on the dollar. Yeah, it makes me proud to own this stuff.
It's an amazing mindset you have with things like that, and I'm in between that. I like when it's dropping, but now I'm watching it keep dropping, And the struggle now is, do you wait for it to keep dropping, or? And I find myself getting greedier with my. So I put in some prices that I want to buy at. So I have, say, T row price, for example.
Yeah.
I had it at 105, and then when I see it dropping, I lowered it down. It just, because
Yeah.
you just feel like it keeps dropping. So it's definitely a
Yeah, but
learning.
this is where you really need to think from a dividend income.
Yeah,
Really start thinking about dividend income and fair value, right? You need to have, in my opinion, a fair value in your mind. For me, T row price is like I don't remember, fairly valued at 150, let's say.
yeah,
So for me, T row price, hand over fist. I have already bought a lot, so that's why I don't need to buy now. But if it gets to 100, I will buy again, right? Because I also don't feel like you have, yeah, because I wrote an article on my blog about it, how to how to buy stocks in a crashing market or something like that. So first of all, you have people that say every 10% down, I buy again.
yeah,
I follow this principle as well. But if I bought it already in a month and it drops 20% in a given month, I will not touch it anymore that month if I spent already enough or my bracket of money on it, right? Just as a safe fail mechanism to myself. So there is this thing like how you said that it's not good to only do 10% because that's what I learned because I've been falling, catching falling knives like that. So for me, it's not just the bracket down of 10% or 15%, whatever you use, but also the time
yeah,
distribution.
yeah.
I don't want to build a full position in 3 months or something like that.
Yeah, yeah, and that's probably my learning. That's something I have to maybe try and incorporate something like that, because I find myself, particularly now, I watch, and I'm seeing the market keep falling, and I'm just expecting it to keep falling, and I'm lowering my price expectations. But maybe, yeah, I have to really sit down and think about that. But do you know what? I need to get back to blogging and really start being a little bit more disciplined, and get my
Hmm.
clear vision. I feel like I've taken a step back with work and stuff, and I'm not as focused as what I should be. And I've
Yeah.
noticed that, particularly with Siemens and T Rowe Price, I've noticed that because I keep lowering my price expectation, even though I would be happy to own both at these prices. So it's
I have similar instinct like what you're saying, right?
yeah,
I'm just trying to put rules in place to prevent me from doing that.
yeah,
Because I don't want, for instance, now I don't want to buy crappy stocks at 7% yield because it's low. I want to buy high quality stocks right
yeah,
now.
yeah,
And for instance, Texas Instrument is a high quality stock for me. But I'm also thinking sometimes like, okay, maybe I should wait until it's 130. And then I think like, oh no, I loved it at 166. I must really have a boner on it at 142 then or something like that, right?
yeah.
So I'm trying to really rewire myself, but to your point, it's really difficult. It's really difficult.
Yeah, but that's where I find myself. So I'm going to try, and actually that's going to be my goal for quarter three. I'm going to try and push myself into that, because just going over my portfolio now, I've lost. I spoke to you. I lost most of my data that I had in my sheets. Google sent me an email saying I was reaching my limit. I deleted a load of stuff. Did not know that was in there until it was too late, and I can't get it back. But I've managed to cobble together 2022 into the sheet, so I have that data. And I've made some acquisitions this month, so a lot of them would be in CEFs, so closed end funds. Some of these are really high dividend, so they'd be 8, 9, 10%. They have long dividend history, growth history. So one of them is Eden Vance Enhanced Equity Income, and the other one is Clough Global Equity Opportunities Fund. So they're the two that I've been averaging into. I've owned them before, so I'm just building up them positions as they drop. You will notice I do have ASR Netherlands there. That was purely for dividend capture and options play. There was another one, Eagle Bulk Shipping and ZIM are both then of similar. So they're not really dividend income, even though I am now stuck, as I said, with ZIM. I have got an email from one of our listeners actually giving me a little bit more reason to be cheerful, at least owning ZIM, and I will reply back to that email. But for the moment, they are dropping hard in share price. So anything I've earned in dividend income is washed out with the share price. But there's a huge lesson there for me. sell it when I say I'm going to sell it and not get greedy with calls. But in terms of dividend stocks, I bought some more orange. So telecommunications, it's high yielding. It's a short term play for me, and I just increased double that position to 200 shares. And I always dip in and out of all three. So they are. I have them. I sell covered calls. I think when they get above 50, I sell covered calls. I sell them, and they drop below 50. I start to buy them again. So I bought them. So they were my acquisitions this month. Haven't sold a whole lot other than the ones with the option income, ASR. Pretty much, I think that's pretty much the only one that I've sold. Dividend income has been pretty impressive this quarter. I mean, it's far exceeded my expectations. May in particular, I reached nearly €900. I mean, if you had told me I'm going to reach that figure back maybe last year, the year before. Now, a lot of that is because I bought ZIM. ASR is in there, the dividend, and also BASF, which are three big ones to have. But if you exclude May for that, because May is always going to fluctuate, be the biggest with European companies, my average has gone up to nearly 200 over. If I look at March, April, and June, for example, my average is now 200 a month, which is pretty impressive for me. It's double where I was last year. I think I was just under the 100 mark last year. So in the space of a year, I've doubled my income each and every month. My largest holding, actually, I was surprised, just logged on this morning. I think I said it to you. I noticed it with you, is now Unilever. So for me, that means that Shell has taken a dip in share price. I don't know. I haven't checked, but they must have, because they were my largest. And I think I have some things wrong in this spreadsheet, because it says consumer staples is 64%. It's not. It's around 30%, but I don't have everything tracked from 2001, 2002, 2020, 2001. But all in all, it's a good month on dividends. My option income as well averaged around 400. Again, May was a monster month with nearly 1,000 there. So between option income and dividend income, I averaged about 800 a month over this quarter, which is
Oh, wow.
which is decent for me.
I think you will retire quicker than you might consider right now. I wanted to ask you a question,
Yes.
because you're doing quite well with option income. I'm observing already, also in the downturn market.
Yeah.
Right. So would you, let's have a hypothetical question. Let's say that your expense coverage is 50 or 60%, and you could cover the other 40% with option trading. Would you consider throwing in the papers at work and just do it as option trading?
Not quite yet. So the option income looks good, okay, but remember, that is premium that I've received. Okay, I have been left. There's a lot of learnings that I've made and I'm making. So I have companies like Wish, for example, Solo as well, that I have held for over a year. That if I was to sell now, my realized gains on them are quite brutal, to be honest. So that will wipe out a lot of my option income. So I'm holding them. I keep rolling contracts on them and getting income until they get to a level. I think I have Wish down to about an average price of $3.49. My initial price was $9 or $10. They're trading sub $2. So I have a lot of work to get that down. So at the moment, yes, the option income looks good, but I also have to take into consideration the positions I hold.
The capital gains loss.
Yes, and I'm holding them. They're bag holders for the moment, but it's all a learning. But maybe 5-6 years, when I've really have my plan nailed down, I'm really disciplined, and I stick to high quality companies, then maybe it's an option. Maybe it's a possibility. But for the moment, I'm using a small amount of money, using it as a learning growth phase, just trying to supplement my income and trying to really stick to my plan, which sometimes is, as with ZIM and others, is not always the case.
I have this experience with BASF now that I did this dividend capture, but honestly, I'm totally happy that I bought BASF at that price. It was like 52 euro. I think it's trading now around 41 euros. So there's a capital loss, but we know this because it's a cyclical company.
Yes.
So those 100 shares that I acquired, I'm keeping them. I'm not even doing how is it selling calls on them now because I'm happy with them being in my portfolio. I just keep them there.
I mean,
And yeah,
there's a difference there in selling puts for a company that you want to own, and then selling puts for premium that you don't mind owning for a short amount of time.
yeah,
Um, at the time, I rationalized in my head, yes, I wanted Wish. I would not mind holding Wish for 1 year. Here I am, what, 12, 13, 14 months later, still holding
yeah,
them. Do I want to hold them for another year? And if I sell them now, I lose some money. So
yeah.
it's
So
constantly
for
that.
me, it sounds like the classical example of chasing yield and therefore taking more riskier bets.
Yeah, but I do think there is a fine margin. There is a line there with safety, and I just have to nail it, and then I might consider it a little bit more.
Yeah,
But for now, dividends for me is always number one. That's
yeah.
my focus, and I'm using option to because I always have that bit of trader in me. I like to trade
Hmm.
and have it in me, and that kind of satisfies that.
Gambling,
Yes, yes.
casinos.
Yeah,
Yeah.
exactly. So that satisfies that. And to be honest, it's with, as I said, a small amount of money. Once if I hit a limit where I'm holding too many companies, I'll just stop and wait until I get rid of them.
Super. Hey, this was awesome. I think you're doing an amazing job, EMF. I've said it also in the other quarterly performance. It's so inspiring to see you. I know you're a little bit later on the journey than where I am, but I'm learning a lot from you as well, and it makes me always wonder. I should have done it a bit different in the beginning. Yeah, but I think that's the thing, right? If you look at others, you always learn something, and
Yes.
for me, it's really inspirational to see how you're doing it, how you're committed to it, and also your thought process. Yeah, which is really interesting.
Yeah, and I suppose what I try get to the listeners is sometimes we get questions like we're gurus, for example, and
No, we aren't.
my point is this: I'm clearly not. I make a million mistakes, and I try and highlight actually my mistakes more than my successes because I want people to see that these happen. But I think it's important. I mean, you learn. I think. Well, I do. I learn more by doing something and make a mistake than
Yeah.
copying somebody. I mean, I could easily copy your portfolio and have great performance, but I don't learn. I don't know what I'm doing.
Yeah, or for me, it's overthinking as an example, which
Yeah,
usually leads, in my case, to inaction, and therefore I don't benefit from something, right?
yeah,
So, and then this where investing becomes really personal because it's raising your kids. You see yourself sometimes in them, and the behavior you don't like. You realize, shit, this is me when I was young. The
yeah.
same is with investing. There are these patterns that really, really come close to your character, and it also highlights your strengths in your character, but also your flaws
Yes.
in your character, right?
Yeah, and to your point, rewiring is so hard, isn't it? To rewire
Yeah,
your brain to change because it is your character, it is your instincts, and to change your instincts, to change your thoughts, your subconscious, how you react to situations is quite good. But I mean, as investors, we've had some. I mean, we've had since I started, we've had a bull market of greater than all time. We had a COVID crash. We also had a rebound, and now we have a proper market crash. So I get a flavor of all different types of markets, and
exactly.
that's I think that's quite good. I mean, 10 years from now, if I don't learn from this period, then I never will.
Yeah. Yeah, and honestly, I think we're not done yet this year. So
No,
I truly hope that we see another 20-30% decline because we get better dividends. Yeah, but if you, for instance, if this would be 3 years from now still down, and I wouldn't see it really in dividend income back, I would probably be thinking like, shit, I lost so much money, which I could have spent on holidays,
yeah,
house, was it all worth it? So it's also a little bit where we are in time, right?
yeah,
How we look at our portfolios.
yeah,
Good. Super. Having said that, let's then go to some listener questions, Derek. And the first one is from Mark Orosi from Facebook, and he's asking, what are our thoughts about Texas Instruments versus NXP Semiconductors. And he feels that both seem like fairly valued, and he's wondering what is, according to us, a better buy, and are we considering NXP?
I mean, I haven't really considered NXP. I know they're the European equivalent maybe of
Spin-off from Philips.
yeah, but I have never really considered them. He gave us a nice little graph with that, and it shows market share, and you can obviously see Texas Instruments, Analog Devices are the two main ones. But it gives room, doesn't it, for the likes of NXP to grow when their market share is so low. I think it's less than 5%. There's obviously more room for them to grow than there would be for Texas Instruments. It'd be harder for Texas Instruments to grab more market share than it would be for NXP. But uh, honestly, I have never looked at NXP enough to make that judgment call. I know you talk about for the sake of diversification, but I'm happy enough just holding Texas Instruments.
Yeah, I think NXP is really interesting. Until recently, the yield was just not there for me to really take it seriously. It is now yielding, I believe, 2.3%, and the payout ratio of 21%. So that says a lot about the valuation at the moment.
Yeah.
Yeah, and if we see how it's dominating the market or growing in the market, I think NXP might be really interesting. So if you're looking at it from a point of view, I want to diversify and not put one bet on a player in the semiconductor industry, then NXP might be a good consideration. I'm looking at it from a different point of view. I own already Intel. I own already a really small position in ASML, and I own already Texas Instruments. So for me, this is enough exposure to the semi industry. But if I wanted to zoom in and I wanted to look at the analog chip industry, let's say, then I would definitely take seriously as a diversification away from Texas Instruments. I would seriously consider NXP because it's the fastest grower there, in my opinion, with the best value proposition. So
Yeah.
but I just don't need it now in my portfolio. That's my
Yeah.
my thinking here.
And the only other aspect is Texas Instruments is a proven dividend grower over decades. NXP doesn't have that yet.
Yeah.
So for me, I don't need to zoom in and diversify within a specific industry. I'm happy. I'm happy on top.
Yeah, this kind of like how is it? Investing in Zinedine Zidane versus the up and coming talent, right? I would always go for the Zinedine Zidane of the industry.
Exactly. Drip has asked us what did we add in quarter 2. I think we've
Yeah.
answered that. We have a question from Herman. What are your thoughts on BESI and the Allstate company?
So from BESI, I would just always recommend to visit the blog from the Kleine Kapitalist. We can put the link to an article of BESI for him as well in the description of the show. Look, I always stayed away from BESI because I think BESI is a good company to consider in the semi industry, also from the Netherlands, if you're investing for a dividend income and are looking for a good dividend stock. However, I'm looking for dividend growth stocks, and I don't see BESI as a dividend growth stock as such because they cut the dividend from time to time. This is just known. So it really depends on your investing philosophy. I think you would do really well over the years with BESI from a dividend point of view, and on average, I would expect dividend growth, but it's just not stable dividend growth, and that's why I'm staying away from BESI. But I think generally it's a good company, solid company, and I think it is also trading now in a value zone, although I haven't looked deep into it. I'm not able to say anything about Allstate company at this moment in time.
Okay. Me neither. So we'll move on. La Collector de Dividendes has, I think it's more of a recommendation, but he has mentioned that there are excellent investment management companies on the LSE, on the London Stock Exchange at the moment. Schroders, Intermediate Capital, and Lion Trust are two that he gives with great dividends and of high quality. I don't know. I don't know a whole lot about these. I've heard about Lion Trust, similar to T. Rowe Price. They're an asset management company. I haven't heard of the other one, but I will take a look. Thank you.
So what I can only say is I studied all the 100 companies from the London Stock Exchange, right, the FTSE,
Yeah,
and I went through the dividend histories of Schroders and Intermediate Capital here.
yeah,
Both got their dividends during the great financial crisis. No surprise, they were in the
yeah,
blast zone. Yeah,
yeah.
so they currently yield 4.4%, both, I would say.
Oh,
But for me, they are not the best dividend stocks for that reason. Also, in the London or on this exchange or in this index, that's why I didn't further look into it. And I find T Rowe Price superior to these. But what is interesting, of course, if people want to invest, like if you're in Poland and you, how is it? You have this retirement account, IKE or IKZE, you can invest tax free, right? And you don't pay dividend withholding tax. That's why the London Stock Exchange is really, really popular in Poland as well. And I can imagine that people want to look into that. So the tickers are ICP, and the second ticker for Schroders is SDR. So 12, 13 years dividend growth, yielding both around 4.4%. Yeah, so I think they are might be interesting for further research, but I'm staying away from them.
okay. S-Lint has asked, what are your best dividend months? May and June
May,
for me. Yeah.
yeah, me too.
We have
Oh,
a
and August, in August as well, because I get then Ahold dividends and many quarterly payers as well. So August is also always a good month for me.
the Sly Badger has asked us our thoughts on the semiconductor industry. It is crashing now. What is going on there? Perspectives.
I think we have spoken about this before. I think there's so many things going on in this industry when it comes to just getting the products to even produce this because of the Ukraine war, um, COVID lockdowns in China. All this stuff is really creating supply chain issue. We had a ship blocking the Suez Canal as well. So I mean, if you think about the perfect storm, that's the semi industry. Top of that, we have inflation, a fear of weakening consumer demand, and electronics are, I think, one of those things that you can easily save money on. Yeah, if you need to look at your budget.
Yeah,
So yeah, these are all headwinds. But the everything digital trend that is going on in companies, artificial intelligence. I mean, we're still at the early days of this, so these trends are not going away. And actually, artificial intelligence is a really good thing for a business case to reduce people in the company as well. So for me, I'm really bullish over the next decade. And if you look, for instance, at ASML, their order book is already filled for the next 6, 7 years. So I'm totally not concerned, but you need to look really at the highest quality companies in this sector. And Texas Instruments, ASML are definitely there. Intel is not the highest quality. Intel is for me a turnaround story. I think I'm bullish on their turnaround, but you will need to swallow pain in between. Yeah, but this is how I look at the industry at the moment. So I see it as a gift that is crashing and as a big opportunity for us because 2 years ago, these stocks were out of reach for us.
yeah. I mean, the crashing because the general macroeconomics is so unstable in lots of different areas, but the quality of the companies has not changed, and I think that's the key part. And just study Moore's law. I mean, we know that every 2 years transistors are going to double, and a lot of companies mention this in their reports that that's what they're aiming for, that's what they're achieving. So we know these are going to grow and grow and grow. So I think it's a good time to stack chips now, and particularly when they're crashing. But focus, as European DJI said, focus on quality because they're the ones that will ultimately come out on top. Manny has asked us, with the markets down, is it a good time to bump up the allocation in dividend distributing market ETFs as opposed to dollar cost averaging into your core portfolio holdings? Um, I would say for the majority of people, probably yes. If it's probably easier, it's probably a good time. For me, it makes no sense with the tax in Ireland and deemed disposal It makes zero sense for me to do that.
Yeah, and I think actually opposite. I think ETFs would have been probably better off when the market was high, because now we're entering the land of opportunities. So I think actually in the reversed way. Yeah, yeah,
Yeah, I mean, I get what you're saying, but most of these ETFs have probably most of these most people's core holdings within them.
yeah.
So I don't think there's a wrong answer there. Just Marcus asked us, is there a way to request my Unilever dividends in ice cream?
Yeah, and he put a picture of Ben and Jerry's under there, and maybe this is a nice topic. Have you heard what Unilever did with Ben and Jerry's?
Have they spun it off or?
No, but they screwed them over. Remember the story that Ben and Jerry's didn't want to sell ice cream anymore in Israel?
Yeah.
Yeah, and Unilever couldn't do anything
Mm.
because they have in the contract written that the board of Ben and Jerry's can effectively do whatever they want. So if I understood it well, Unilever has sold the patent for Ben and Jerry's, or the selling rights, to another company for only for Israel.
Wow.
So what you can imagine is that because that's what Unilever owned, so it must be war between Ben and Jerry's and Unilever at the moment, because this is really damaging long-term relationships. And I'm a little bit concerned about this, because this is again Alan Yopi, right, here. And if I would now be an uprising consumer brand, and I would like to cash out on this or find a home, would you go to Unilever after you heard that someone was screwed over there?
No, no way. I mean, I'm surprised. Like, spin the company off, get rid of them. Like, I don't like underhand tactics like this. It's
Exactly. This, and if you are Unilever and you want to do mergers and acquisitions, and specifically acquisitions of this, you need to have a really good reputation. For me, a company that has that is Roche, as an example, or Berkshire Hathaway. You know that you'll be left alone, and you know what you need to give up, and that's your cash flow, right? And then you have a good deal. You can still build a company. You benefit from the supply chains and everything. Um, but Unilever is now creating a distrust here, and Alan Yopi, for me, it's another reason why he needs to get fired. I understand what they feel with Ben and Jerry's, because we're talking here about this wokeism and such, and becoming politically engaged as a board of directors. I think we need to somehow separate capitalism from political engagement here, at least to this extent, right?
yeah.
So, but if you have a deal with them where this is written in their value system and their principles, you need to respect it. Yeah, you just, it's a contract that you did not under influence of alcohol or drugs. You've written this and signed it fully aware, so you need to respect it at all costs. And yeah,
It feels like the Unilever board have just thrown their ties out of the pram. It's like, we can't do anything to you over your stance in Israel, so we're just going to be petulant and pick something we can do. And it just to me, it's senseless. I can't make I can't make sense of why you would do something. There's so many better ways you could do that. Obviously, spin the company off, get them off your books altogether. That's one way. But to go behind our back like that is not a good sign.
exactly.
And uh, I mean, this
It's
last
your
year,
largest position.
yeah, this last year, it's been really tough as a Unilever shareholder. There's no positives at the moment. None. It just seems to be all negative, and I don't know. I might have to reconsider my
Yeah,
position.
and the magnums are getting smaller again.
Yeah, they're
It,
tiny. Yeah,
they're shrinking every year. I mean, I remember the mid 90s. Maybe I was also smaller, right? But these
yeah.
ice creams, they were like, I don't know, 300 grams or something like that. These were huge with really big chocolate around it.
It
Now they're becoming like little ice
yeah.
creams.
It's funny you say that. We had this exact same conversation in work. I mean, how small can they go is the question. Like, are we going to get invisible ones? Like, just this used to be an ice cream.
Yeah, exactly. But this tells us just that the company is really struggling, right? Because they are not able to hike the prices
Yeah.
here, seemingly, or maybe they're doing both. Yeah, but that means that they can't keep up with the return on investments they want to get from it. And it's the same with I noticed with Lays. Yeah, the bags with the chips in it are often also getting, every year like 10 grams off. Yeah, it's like until you have small bags again.
Yeah, it's I don't know. I'm starting to doubt. I'm starting to really doubt my Unilever position at the moment. So, look, we'll see. We'll see.
Yeah,
Hopefully, hopefully they'll turn a corner. We need that CEO to go. We need him to go.
yeah. Alan Yopi needs to be gone. Yeah.
John Barraclough, what would you like to ask? Sorry, who would you like to ask a question to, and what would you ask them?
I would love to ask a question to the original founder of Hershey, the chocolate manufacturer. And I would like to ask him, like, how has he created this institution with the orphanage and such as a security to his wealth? I'm still like astonished and amazed by how well he has done this, because there was like 2 years ago, I think Mondelez wanted to take over Hershey, but they can't do this without permission from this whole institution. I think orphanage and everything behind its schools, and they said no, right? So what why I'm saying this guy or this family has created a shitload of wealth, and they found a way after their death to still protect their wealth and people to benefit from it. And I'm sometimes thinking about this, like, how do I ensure that if my wife and me pass away, that my kids don't just bash it straight away on booze, drugs, women, or men, whatever they prefer. Yeah, so I would like to see how did he do this and how did he construct this? Because this question sometimes coming into my mind, like, how do I preserve wealth?
Yeah. Okay.
How about you?
I I never. I'm not as curious a mind as you. Obviously, I've never thought of that. But I'd probably ask maybe Warren Buffett or Charlie Munger if they were to start today, right today, with my income. Right, they have my income, my bills, everything that I have. What would they do differently to me?
Mm,
I would love to know what they would do in my position, not in their position because they got so much
yeah,
money now. But if they had everything I had right now, what would they do differently? Hopefully, he'd say nothing, and I'd be happy.
yeah. Let's let me know when you get the answer.
Yeah, yeah. I just have to pay about 4 million for a dinner with him or something.
Oh fuck.
Uh,
Good.
Mark has asked us, do you think we'll enter an area of protectionist economic policies that will materially affect the shipping industry?
I'm not knowledgeable about the shipping industry, so I can't say. But generally, yes, I think we will see more protectionist policies. We see it already with the UK putting an extra additional tax on oil and gas companies for their profits this year. So I think we'll see more of this in other industries.
Like we know governments want a piece of the pie, don't we? So when they see industries that are starting to soar and getting out of control, not even out of control, but when prices are increasing and profits are increasing, governments like to rein that back in and say, "Hey, pay Uncle Ben here. We need a piece of the pie." So you could certainly see that, but I'm not an expert in this industry. I'm just stuck with ZIM. So um, I don't know, but I would imagine we'll start to see something. Maybe. Jeffrey has asked us that he knows we love Texas Instruments, but have you been considering ticker AVGO for that sweet dividend growth too?
No, I don't like Broadcom. I know they are awesome as a dividend growing company, and I know they've done well over the last decade. I just don't see it as a sustainable business. Well, because what they do is they acquire companies, kill the whole cash flow and the innovation in the company, maximize the free cash flow with that. So for me, this is a company like a leech. They really suck everything out and distribute that back to the shareholders. I think this works as long as you're in a position to acquire, but at a certain moment there will come the day of reckoning, and then you will see this company is underinvested, losing market share. I don't know if that will be in the next 5 years, the next 10 years, the next 20 or 30 years. It just doesn't align with how I look at sustainable business growth when I want to invest in companies.
Okay, cool. And the last question comes from Samuel. Is there any high dividend stock that you've seen on sale recently? And by high, he means yields closer to Omega Healthcare.
Not really. Not really. I mean, on Facebook was mentioned Rio Tinto, but I think you shouldn't look at those high dividend yields because it's cyclical. At the moment, it's still a lot of tailwinds for a company like Rio, so maybe the dividends safe for another year. But no, not anything that came on sale. And I must confess, I haven't looked back at Chesnara for the last few months. So, and Chesnara is currently having a yield of, okay, so it's nicer now. So it's yielding 9.47, no, 8% at the moment. Sorry, 8%. 9.47 is my yield on cost. So, oh no, Chesnara is also up. So no, nothing from my side.
Okay. Not particularly in stocks. I've mentioned closed-end funds earlier. There's quite a few starting to come into well under their NAV. So it's an interesting market at the moment. So usually when you see a crash or a market turn, closed-end funds will drop hard. And that's probably a good time to start buying them. I would stick to the main ones. There's been ones that have been around 40, 50, 60 years with a proven dividend growth track record. They're the ones I would stick to. Okay, that's the end of season 2 and year 2 of our podcast. How do you feel?
Uh, I mean, I love doing this every weekend. I mean, I love the conversations with you. I can tell you, if I wouldn't have this, I probably wouldn't have had the same learnings and growth in my dividend portfolio. So you effectively make me wealthier. So thank you for that.
Yeah, it definitely helps. We get so many questions and challenges and emails. Everything, I suppose, everything we say is challenged, which is good. We like that and encourage that. Obviously, as we said, we're not gurus, but I mean, 2 years, I'm happy, and thanks to all our listeners, not only for listening to this episode, but has stuck with us from day one or wherever you landed on our journey. We do appreciate each and every one of you, and just want to say thank you. We will see you all next week.